Well, stocks advanced last week with the S&P 500 gaining for a second week in three as treasuries rallied as well, led by the long end of the curve in a move that's extended in the early part of this week as Trump names his Treasury Secretary pick. And the dollar continues in a firm footing as well, gaining ground last week for the eighth week in a row, amid an increased focus among market participants on geopolitical events. A holiday-shortened week now awaits this week, with Thanksgiving on Thursday and most US participants away on Friday as well, bringing with it a relatively light data docket. But we do nonetheless have plenty to discuss on the trade-off this week. So without further ado, let's get on with the show. So joining me as always on the trade-off is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. I suppose you missed me terribly last week while I was away.
Who are you? What's your name again?
It was only a week, mate. I haven't changed that much. Come on, I know I've had a fresh trim, but.
Oh, that's a haircut, is it? Okay, I thought you were falling a bit short there on the old hairline. But no, welcome back.
Do we really want to go down that route?
Listen, I can't go any further down that road. Okay, so I'm at the end of it. But yeah, no, you missed a big week. So I hope you. I know you saw some of the moves going on last week, but yeah, not the best time to take off, mate.
Well, yeah, exactly. It's often the way, isn't it? You take what you think will be a quiet week off, and then it turns out to be rather eventful. But you know as well as I do that it's always very difficult to completely switch off from the markets while you're away from the desk. And as you said, there were a few bits and bobs happening last week that we can get into now in Topical Thunder. Right, so I guess one of the key things that stood out to me last week was what was going on here in the United Kingdom. We had quite a lot of UK data out last week, and I guess it was a pretty grim combination, to be completely honest with you. Inflation remaining sticky in October, headline CPI rising by 2.3% on an annual basis. That's above the 2.2% that we expected. Now, a lot of people were expecting inflation to rise due to the increase in consumer energy prices and the rise in the off-gem price cap in October. But even when you take energy and food out of the number, we see inflationary pressures remaining pretty strong and pretty persistent under the surface. Core inflation, that rose by 3.3% in October, and services CPI, that rose by 5%. Both of those up by 0.1% from where they were in September. So when you've got the BOE focusing on signs of inflation persistence, well, I think it's pretty tough to argue that, against that data showing that inflation is indeed remaining pretty persistent within the UK economy. We also had the latest consumer spending figures last week in the form of October's retail sales data. Headline sales were very grim, falling by 0.7% on a monthly basis in October compared to the 1/3% increase that we saw in September. And excluding fuel, sales were even more grim, falling by 0.9% on the month, which is incredibly poor performance. Now, some would say, maybe this is a few pre-budget nerves. Maybe this is consumers tightening their belts ahead of a spending splurge over Christmas and the festive period. I'm a little bit dubious of that one, to be completely honest with you, particularly with consumer confidence remaining in the doldrums. Now, if that wasn't bad enough, we also had the latest public sector borrowing data, which showed the second highest October monthly borrowing figure since records begun all the way back in 1993. And on Friday, we had the latest composite PMI figure, which fell to a 13-month low at 49.9. So in summary, you have a combination of sticky prices, stalling at best economic growth, and ballooning government borrowing. And of course, this comes ahead of the rise in national insurance contributions, the lowering of the national insurance threshold, which kicks in from April. It's all a bit of a toxic mix, and perhaps you could call it stagflation light. Now, I think this will keep the BOE on this gradual easing path. I don't think another cut is likely this year. Probably February is the likely time for the next 25 basis point bank rate cut. But arguably, this is a BOE that are staying hawkish for the wrong reasons. It's not a BOE that are hawkish because economic growth is resilient and it's allowing them to keep policy tight. It's a BOE that are being forced to keep policy tight because they just cannot get rid of inflation out of the economy. And I think that's really starting to have a detrimental impact on economic activity now.
Yeah, and as you know, it's a drum that I banged a lot last year and through this year, that inflation's always going to be more sticky in the UK. That's just the nature of it. And so it's no surprise that they're up against a brick wall again in seeing more sticky inflation coming through. On the other side, as you say, growth isn't looking overly optimistic at the moment. So we are potentially heading for problems. And what the BOE are going to do about it is another question. Do they ease on the lower economic side, or do they keep tight on the inflation side? It's a battle quite a few central banks are having to face at the moment. So they're not alone in that. It's not looking, the overall picture is not looking good. I mean, I don't know what it's seen like from outside, but you and me being here in the UK, every time you pick up a paper, it's bad news. The government are getting slated for this, slated for that. So they've not got off to a good start. And if that really starts to impact investors and investment, then, it's not going to be good for the quid. It's not going to be good for UK stocks, and we're going to see more downside.
Yeah, indeed. I mean, I would say that the FTSE was up by about 2.5% last week, but most of that was because sterling fell off a cliff and cable traded below 125. I mean, yet again, particularly for those newer viewers, the FTSE 100 is not representative of the performance of the UK economy. I guess one sort of silver lining among all this is that no matter how bad things are here in the UK on this side of the channel, things seem to be even worse in the Eurozone.
Yeah, I was waiting for you to make that conclusion. Come to that conclusion, mate. It seemed pretty bad over there as well. When if last week's PMIs were anything to go by, then Europe is going to see out 2024 on a bit of a downer. The issue here is that we've seen this weakness.
See in 2024 on a downer.
Well, I'm just about to say, the issue here is this weakness has been going on for 2 years, nearly 2 years now. So it's been especially prevalent in manufacturing, and while it's been less so in services, that sector has only really had a few good prints over the last, since late spring, early summer, before it's turned lower again. So Europe is in a slump, and that slump could get, it could really start deepening through the rest of the year and into 2025, and that's going to be a big, big problem for the ECB. At the moment, the ECB see no real problems. They see weakness and risks, as they always do, but they don't see a deeper economic contraction. And, you only have to look at the last 2 years to know what happens when a central bank doesn't plan for something everyone else can see coming. So they're going to be facing some problems. The ECB still think they are just normalising rates after, the inflation shock, and that they'll get rates down to a nice, comfortable level, and then they'll just sit there. But I think if the fundamentals keep going the way they are, and there's every chance that they do, of course, we will see the ECB having to chase a falling economy with rate cuts that will take them well past their neutral level and maybe even closer to zero again. So the question I've got to ask you, Michael, is QE4 coming?
Oh, blimey. Well, it'll either be QE4 or it will be another acronym that the boffins in Frankfurt think up. I mean, we've had PEP and APP and Teltro and God knows what else. It is interesting, though, that none of the ECB bods that we get on the wires, and we get so many of them every day, have actually endorsed this idea of a 50 basis point cut in December, which the market is pricing as about a coin flip at this moment in time, or at least it was when I last looked. I mean, I guess I would kind of say, well, actually, this is arguably a depression now, particularly in the manufacturing sector in Europe. So what difference is a 50 basis point cut actually going to make? I think these issues are really structural in nature. But what I did find interesting on the subject of ECB speak is that the chief economist, Philip Lane, was on the newswires this morning, Monday morning, for those of you watching. And he said, and I quote here, "We are in a cyclical recovery phase." Now, if he thinks this is a recovery, I would hate to think what he thinks is a downturn, because I mean, I don't know about you, but I can't see anything in Eurozone data that suggests that there's a recovery on the cards. And I'm not saying the ECB are going to go back there, but we did hear from the chair of the Swiss National Bank a couple of weeks ago saying that he's not ruling out the SNB potentially going back into negative rates. We thought we'd put that era to bed. And, well, I wonder if the ECB are going to have to go down a similar path back to zero much, much quicker than they were really hoping to do so.
Yeah, I wouldn't rule that out, mate. And, talking of ECB speakers, we had, one of the big hawks, Nagel, speaking last week alongside Vilroy. First of all, they both declaring victory on inflation, getting that back to target. No worries about it shooting through. So that's obviously going to come back and bite them in the backside. But one dovish slant that Nagel took, he said that the size of a December cut will be based on the projection. So that from a hawk was a real dovish slant that, 50 is perhaps, on the table there. And as you said, expectations after those PMIs shot up from less than 20% for over 50%. So there has been a big shift. Maybe they are going to be forced into one, and I think that the data is going to push them that way.
Yeah, potentially, although we do have Eurozone CPI, which is due out on Friday. And given that is actually November data, it's flash data for November, and that's expected to be a little bit hot. I think 2.3 is the consensus for the headlines, and that may deter the ECB from more aggressive action. In any case, moving on, another key risk facing the Eurozone, and that is a very, very long sort of laundry list of risks, is the geopolitical situation. And although I was sitting in an armchair last week rather than sitting at my desk, it did appear that market participants were paying considerably more attention to geopolitical events than they have done recently. And I suppose this is really coming ahead of, obviously, Trump returning to the White House in mid-January. It would appear that Western nations are really stepping up their support for Ukraine, and I suppose trying to effectively sort of Trump-proof any support that they are giving Ukraine in this ongoing conflict with Russia. Now, the main development last week actually came as a result of Western nations allowing their missiles, whether it be the United States or the United Kingdom, to actually be fired into Russia and at targets within Russia, rather than just those Russian targets that are located within Ukraine. Now, that's clearly a bit of a shift in posture. Now, in retaliation, or apparently in retaliation, we had Russia revising their so-called nuclear doctrine, lowering the threshold at which those weapons could be used and expanding the potential for their use. Now, there's a lot of war of words and there's a lot of rhetoric going on, but it does appear that tensions are seemingly escalating as we move into the winter, and obviously the conditions are about to become very, very cold indeed on the battlefield out there. And of course, this also comes as another issue facing the Eurozone. Tensions in the Middle East remain unresolved, although there are some tentative stories out Monday afternoon suggesting that Israel and Hezbollah may be on the verge of a ceasefire. But nonetheless, markets did price a significantly higher geopolitical risk premium last week. We saw WTI up by about 6%. Brent was up just shy of 6% and back north of $75 a barrel, while gold, that rallied about 6% in its best week since March of 2023, and up to Friday's close, notched a whole week of daily advances, which is the best run since April. So it's just interesting that markets, as is so often the case with geopolitical events, we kind of forget about them. They're going on in the background, and then all of a sudden they're back on the radar, and everyone's thinking about the situation once more.
Yeah, and we've been watching this potential escalation that's been going on over there, and it has stepped up a big level. The US obviously allowing missiles to be used into Russian territory, UK and others joining in as well. So it's been a big level up where, to put it in one term, the toys are getting bigger in size in terms of what they can use. So there's naturally been a step up in that escalation. The issue we've got is two things. The next step up from there is obviously nukes. Okay, so that's the final step where we don't want to get to. But on the flip side, it might be the final step that actually gets people around the table. If we see, barrages going back and forth and widespread devastation going on, then that might force all sides to finally say, look, we need to sort this out and come to the table. Now, whether that aligns with Trump sitting down in January and solving everything within a day, who knows? But while it's a bad situation now, it could finally, hopefully, lead to a resolution later on.
Yes, indeed. We shall see. Only time will tell. And of course, that is what we hope for. Right. Well, I'm off to go and get my tin hat, a can of baked beans, and hide in a bunker, Ryan, while you discuss the United States economy, I think.
That sounds like your normal weekend, mate, if truth be told.
Where do you think I've been for a week?
Exactly. In your paper bunker. Right. I'm going to talk about the US. And if there's one thing that people in the US have in bundles, it's confidence. And we've already seen some of that confidence emerging in last week's PMI data, where the Trump effect is already having a big positive effect on sentiment. Now, in a country like the US, that sentiment and confidence is often enough to turn into actual increased activity and a bit of a boom for the economy. Now, outside of the cabinet Trump is putting together and what that means for tariffs and policy and everything else everyone not in America is worrying about, the economy keeps turning over, and that's likely to continue to outperform among the major economies. I think we might see some wobbles along the way in the short term, and I think this week's US holiday and sales events are going to determine whether we see those wobbles or the Trump effect. Now, if things are a bit tough for consumers, then the sales events will show that in the data. Conversely, if the consumer is having a big blowout spending spree, then that will signal potentially possible positive confidence for the future. Now, these days we get online sales figures pretty quickly within a day or two after these sales events, so it won't take long to find out what the consumer's doing. The last October retail sales report was a bit on the soft side. Maybe consumers were holding back for these sales events. So it's going to be a key moment to see whether that spending is coming back. But if there's one thing I've learned in my trading career following the fundamentals, it's that you should never rule out sentiment as a driver for an economy. And if we see that happening this week, then it could lead to a bit of a forecast of what's going to happen when Trump does sit down.
Yeah, absolutely. I think you bang on the money, to be completely honest with you. And I hate to keep banging on about it, but you look, at the divergence here in the UK, everything you hear is bad news. I know we contribute our fair share to that, but even from government, coming in, the economy is in a terrible shape. We've got this fictional black hole, et cetera, et cetera, et cetera. Well, now look, we've talked ourselves into stagnation. The economy grew by 0.1% on a quarterly basis in Q3 in the first 3 months of the government, and business and consumer confidence have fallen off a cliff. In the United States, you've got the polar opposite. Everyone's optimistic. Spending seems to be going well. You've got a Treasury Secretary who's going to be coming in and looking for 3% GDP growth, which, we're not far off at the moment. That optimism is helping to fuel what looks like a wave of spending and investment. And you would argue one is the way you should run an economy and one is the way you shouldn't. And I'll let our listeners and our viewers decide that for themselves. It will be interesting in terms of consumer spending over the Thanksgiving, Black Friday, Cyber Monday period. I think what has been interesting of note, particularly in some of the corporate earnings we've had, if you look at Walmart, for example, sales of staples have been very, very strong. You look at some of the big box retailers, someone like Target, sales of discretionary items have been very, very poor, and Target actually ended up slashing their profit guidance in their third quarter report. So I think, again, we sort of alluded to this earlier with the UK retail sales. Are we seeing consumers keep a little bit of powder dry and wait for this festive discounting period before beginning to spend? And obviously the figures that we get from the retailers, and usually I think it's actually Adobe that collate this sort of data relatively quickly. That will help to gauge the degree of consumer resilience as we move into the back end of the year.
Yeah, very much so. And you're right. I think spending patterns have changed these days. If you've got these big sale events coming up, why spend in October when you can wait a couple of weeks and spend later? So I think what we need to look at is whether these, and particularly these online sales figures, are above what we saw last year. Obviously, inflation impact needs to be taken into consideration as well, because we were having 2022 10% inflation numbers, and that was still all feeding through. So it might be a little bit messy, but if you get numbers that are higher than last year, then that's going to show that the consumer has still got some money to burn.
Absolutely. Right, let's move on to some charts and stick with that US theme. Indeed, that is where I want to begin this week, with a look at the dollar, with the dollar index having rallied very, very strongly indeed last week, an 8th straight week of gains for the greenback. And we saw a move all the way up north of the 108 figure on Friday, albeit very, very briefly, with the greenback trading to its best levels since November of 2022, after those dismal PMI figures that we had out of the UK and the Eurozone. And it's clear, really, what we're seeing is a continuation of this US exceptionalism theme. We have a widening, or an apparently widening, macroeconomic divergence between fortunes here on this side of the Atlantic and fortunes in the United States, as we've covered at quite some length already on the show. And I think also we have a potential policy divergence on our hands as well. We're talking about the ECB potentially upping the dovish ante as we move into 2025, just as risks around the FOMC outlook become a little bit more two-sided amid the threat of resurgent inflation as a result of Trump's potential trade tariffs. What does that all mean for the dollar? Well, I think it means upside for now. The key move for me last week was this move north of the 107 figure, which, as near as makes no difference, has marked the top of the 2-year range. So I think in the near term, we're looking for the dollar to remain north of that handle, although we have slipped marginally below in early trade as the new trading week gets underway. And I think key resistance to the upside will be 108 and the highs that we saw on Friday around 108.10. Personally, I favour remaining long for now, and would also remain in dip buying mode, if for no other reason than there is basically nothing else in the G10FX universe that I really like the look of being long on at the moment.
That's a very sour, dour view, mate.
Would you expect anything less over here?
No, that's true. That's true. This is a perfect example of why I don't like the Dixie. That move above 107 was purely about what happened in the euro last week, and the fact that we're back below that 107 level shows it. It's 65% of the basket, the euro. So if you're trading a Dixie, you might as well trade euro dollar. But levels are levels. We're back below that 107 level now. So, and when you get these big spike events that move over, you always have to watch what happens to a level thereafter. And, we're finding it resistance once again at that 107. So that shows you what's going on in any particular currency. Is the dollar yet for turning generally? No, I don't think so. So I think that the path of least resistance for this one is up still.
Indeed. Right. Well, go on. You were moaning and you brought up the euro, so you may as well bring up your own chart.
Yeah, well, I might as well put up a Dixie chart, mightn't I, while we were looking at that one.
Well, I'll tell you what, we'll get Kyriakos to take my chart and just turn it upside down. It'll do the same thing.
Exactly, yeah, that's what it is. So euro dollar, we've had a bit of a big break, although we're back above it today, the 105 level. But this one certainly has shifted gears since we looked at it on our last show. Back then, we were talking about whether 107 was going to hold a break, and here we are 2 weeks later, and it's been down to the 103s. Now, as you can see from the chart, the 105 level is a really, really big level, and this break could be pretty significant. We stopped in the low 103s, which was a decent level in itself, having seen action back in 2022, 2016, and even further. That was in the 103, 30, 40 area. Now, that move did look like a bit of an overextension, though, and we did bounce back quickly. As we record this, we've moved back above the 105 level. We've been up to 105, 25, 30, and that was holding. It was holding 105 this morning, following that Besant news over the weekend. Now, I think there still is a real danger of this continuing to head lower, because the trigger for the drop was those poor PMI data pieces last week. And while the size of the price move didn't really match the PMI numbers and the losses we saw, I think the market really got a massive reminder of the stark fundamental differences between the US and the Eurozone, and perhaps that the Eurozone economy is in a worse state than the ECB think it is, and thus the ECB will need to go bigger and faster on rate cuts. But almost immediately after the PMIs, as I said earlier, we saw 50 basis point pricing up over 50% from sub 20 prior to the data. So that's been the big dovish shift by the market. Now, if there's no improvement in the Eurozone data into 2025, and if the US is still outperforming, I think this is still going to be heading much, much lower. But price action wise, you need to watch this 105 level as a bit of a pivot level for the moment.
Yes, you do indeed. Now, I'm going to ask you a question I was asked earlier
Ooh.
on by our very good mutual friend Ryan Paisley. Now, at the time of recording, I don't know whether the camera will pick this up. We're trading about 105.20 at the moment, Monday afternoon. What do we print next? What do we print first? Parity or 110?
Parity or 110? I would say, I don't know if we will print parity, but I'd say we have a chance of heading down that way. So I think downside before the upside. I'll go with parity.
Now, see, I took the other side of that. I took 110. The reason I took 110 is not because I don't think further downside is in store for the euro. I think it is. But I think we will reach a point before parity where we reach, sort of peak pessimism in terms of the eurozone, particularly if the ECB remain as reluctant as they are at the moment to consider 50 basis point cuts. But there we go. Maybe that can be our sort of next early 2025 lunch bet that you'll end up selling.
Well, hang on a minute. Have you taken this bet with Ryan? So you're going to double up on this one. What did you say to Ryan? I bet you said parity, so you could hedge against me.
No, I've doubled down.
Oh, you doubled down. Okay,
right. Down. Yeah.
Well, let's make this one official, and I'll get on the blower to Ryan after this.
Well, there we go. It's been recorded. We've got thousands of witnesses now. In any case, moving on, let's barrel on through the show and have a look at crude, because we did see, as we alluded to earlier on, some geopolitical risk premium priced back into the black stuff last week. The WTI trading about 6% higher, taking out the psychological barrier at $70 a barrel, and also trading north of the 50-day moving average for the first time in a fortnight. Now, the usual theme with geopolitics has been to fade the market move, or fade the upside at the very least. And personally, I see very little reason to be doing anything different this time around. Although, of course, it is something that you would generally tend to look at over a relatively short time horizon, given the speed with which the situation can change and given how fluid things remain. I think we're still in a pretty bearish demand situation when it comes to crude. The PMIs that we saw last week showed that, with the Eurozone manufacturing at 45.2, UK at 48.6. China is still very much in the doldrums as well. And if OPEC deliver a production increase into that rather dismal demand outlook, then I think crude is only heading one way. So certainly a rally that I'd be looking to sell into for now.
Yeah, I think I can agree with that. And every time we get down to that 66, 65, 67 area, I think about, trying a little long, and I hold off because this one really swings with the headlines. 1 minute we're seeing easing tensions in the Middle East, and then you think, right, here we go, back to the demand picture, and that's weak, and you don't want to be buying it there. But I think we're holding this strong level down in the 65 to 67 area. If we ever break that, I think we've got trouble on our hands, and, we probably might be heading bound even as low as $50. So I'll be very careful with this level. When you see a level tested time and time again over a long period of time, if it does break, then something big is potentially going to happen. Case in point being euro dollar last week. So I would be a bit of a dip buyer, cautious dip buyer, still down into that area. You want to keep it pretty tight, but on the other side, you've got to still sell those rallies, but be mindful how they're coming and what the risk headlines are driving them. I certainly wouldn't be trading this one on a Friday afternoon into a weekend, no.
No, absolutely not. I certainly would not be holding anything here over the weekend. Right, moving on to the Treasury market.
Yep, 10-year bonds, and we saw yields hitting a ceiling last week. And I've been warning on this show for some time that 450 was a big level if we saw yields rallying in tens, and that's exactly where we topped out last week. Well, just over a week ago, in fact. We have backed off since then, down to sort of the 430 area. Now, this could be another significant move as whether it's US data, the Trump trade, risk, or whatever, that 450 is the level where traders have said that's enough and we're going to start stepping in and buying bonds. Now, in price terms, that equates to the 109 level, which is a solid level thereabouts, and that held really bang on the money. Now, this level is important also for what happens with the dollar. We've already seen other dollar pairs peaking out, dollar yen, dollar CAD, in line with this bond top out. Now, none of this means that the dollar or yields can't continue higher, but just that for now, we've hit a bit of a wall, and should maybe expect some consolidation going forward. Now, Trump's candidate is all but announced, so we may see the Trump trade taking some time off, and as I said, until he actually gets in the hot seat in January. Now, obviously, we've got potential for Trump tweets, headlines, and everything else that may pop up in between. But so far, he's been pretty quiet in terms of policy on the social media. So he may be taking a different approach until he finally gets there. I don't think we see yield collapse from here unless we see a big risk-off move forcing money into treasuries like we did with the Ukraine-Russia headlines last week. But I could see a move down to maybe, low 430s, 425, maybe even 420. Obviously, if something causes a breakup through 450, then the dollar will respond in kind and we're going to be off to the races again.
Yeah, absolutely. I mean, I feel like some of this move that we're seeing certainly today with 10s and 30s down about 10 basis points or so now as we speak on the back of Scott Bessent's nomination. I think that's one, probably a bit overdone, and two, probably a one-day thing. Excuse me. I think, you look at some of what Bessent's been talking about, getting the US deficit down to 3% of GDP. Yeah, sounds great on paper, and let's be honest, we'd probably all cut the deficit if we could. But, the US deficit is currently nearer 7% of GDP. So how are you actually going to do that is the question that I would ask, particularly when trimming that deficit is going to involve a hell of a lot of painful choices that are likely to be quite unpalatable, shall we say, from a political perspective. I think the other thing that's worth bearing in mind, it's something I've been sort of harping on about for a little while now, is actually this idea of participants still seeking to lock in yield as the Fed continue with their move back towards a more neutral policy setting. When you've got a 10-year which is sat at 4.3, 4.4%, and you've got a Fed funds rate that is, well, pretty much around that level, if not slightly below in the near future, why would you not be trying to put a little bit of cash away?
Yeah, exactly that. And I've said it previously as well, particularly in the short end in 2-year yields, which are holding up pretty high as well. And that's staying up there while Fed funds rate is expected to come down further. Obviously, if we do see the Fed go on hold for any reason, a pick up in inflation or whatever, and there's some in the market already thinking that, since Trump came in, that the Fed will be forced to cut less, then that might be pick me up for yields to kick on up to another leg. But the Fed don't want to keep rates up here. I think you've always got to keep that at the back of your mind. Where do the Fed want rates? Whether they can get them there is another question, but they don't want to keep rates up here where they are now.
Yes, absolutely. And just on that last point of locking in yield, it is a relatively big week of Treasury supply this week, particularly at the front end and in the belly. We've got a 2-year auction today, Monday, 5s on Tuesday, and then 7-year supply on Wednesday. The key thing to look at for those auctions is obviously the tail or the stop through, but also indirect demand. That is a sort of proxy for participants seeking to purchase bonds in order to lock in a yield, as we were just discussing. Right, we could talk about Treasury auctions all day, but I'll get told off if we do. So let's get on to our plays of the day instead. What do you want, a trade idea or more Treasury talk?
No, I'd rather have a trade idea. Go on, move.
Oh, right. Okay. Well, you were very sort of vehement in not wanting any more on treasuries, weren't you there? Right. Well, let's crack on then in that case. The S&P 500, a bit choppy of late. We have had 2 weekly gains in 3, though. And I would argue that most of the major event risk for this year is probably out of the way now, given that we've moved past NVIDIA earnings last Wednesday, which despite the stock falling 5% after hours, it did obviously recover those losses. And actually, the earnings were pretty good, and the revenue growth of that firm is astonishing. In terms of key events between now and the end of 2024, we've got one jobs report, we've got one CPI number, and we've got one FOMC meeting, and that's pretty much all that is left to come in December. And it's also worth bearing in mind that obviously with Thanksgiving on Thursday, I think what we're likely to see is actually a lot of larger desks say, well, we are pretty much done for the year. You're certainly not going to make your 2024 in the last last 4 weeks of the year, but you could very well lose some or all of the gains that you have made. So I think those participants that are left coming back after Thanksgiving are those who will effectively be seeking to just window dress their portfolios into December as they write up their annual investor letters. For me, the path of least resistance continues to lead to the upside. From a technical perspective, the market is respecting the 50-day moving average as dynamic support. So I would be staying long here, buying any dips. And of course, December, we've had 4 out of the last 5 Decembers notch a monthly gain. So perhaps a Santa rally is on the way as well. Ryan, Kiwi dollar, and we got an RBNZ decision this week.
Yeah, we have, and it's not looking too good for the Kiwi at the moment, and we're sitting on a pretty important level at the 58.40.50 area. We did close below that on Friday, but then we reopened above it today, and it held on a retest. So it just shows you how important this level is at the moment. It's a very long-term level. If we get a move below, then I think we're going to see further downside. It may need to see a daily open below to cement such a move, and that would trigger me potentially trying to short on that basis. We have got the RBNZ this week. They're expected to cut 50, so it's all pretty much baked in. They're going to cut whatever happens by the looks of things. If there is a bit of a shock, obviously, that they only go 25, then obviously we're going to see the Kiwi bounce. But I think this is baked in. But getting a close below that 58.40.50 area on a daily basis, then we're going to be heading lower, and perhaps 58, maybe even lower to 57.70s. That will be the sort of targets around the 2023 lows. So short for me if we can manage to hold below that level.
Are you getting up early for the RBNZ on Wednesday? 2 a.m.
No.
London time?
No.
No, I didn't think you would be. Right, well, that does bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does, despite a few technical issues this morning. The three of us will be back with another show this time next week. No more holidays for me until Christmas. In the meantime, if you've enjoyed the show, please drop a like on the video. Leave a comment as well. Let us know your thoughts on what we've discussed and how you're viewing the markets at the moment. And the three of us will see you again in a week's time. Thanks very much, as always, for watching, and goodbye for now.